Hello and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. Hey everyone, checking in on the market. So we've had a lot of volatility the last 2 days. First with a flush down to the 200-day moving average on the S&P 500. The bulls held that level and saw some significant follow through for the bulls on Friday. So the bulls have short-term momentum in their favor, but they do have a bunch of resistance levels to take out before they make any kind of clear break. The day on Thursday was definitely a break of multiple key support levels. And again, we're in a scenario where the bulls have to prove themselves because the odds of the weekly equilibrium breaking bearish are more favorable than breaking bullish in my opinion. But here we are standing right in the middle of that range. Our low currently is 266.02. And while we broke the low of last week, like I said in recent videos, that would be the initial signal, but it's not game over for the bulls because there are multiple support levels and space to work with before we get to those support levels. So the 200-day moving average is definitely a key level to be watching at this point, and you can see SPY has not closed below that level after touching it essentially 3 times. We had the February dump low, we bounced shortly above it, and then we held it a few times on the April low, and now we held it again on the early May low. But in terms of the range that we're watching, the low 266 and the high of 271, and actually the low was 259. So 259 to 271, a $12 range. 265 puts us right in the middle of that range. And you can see we're slightly above the middle of this weekly range. But in terms of resistances to look at, we've got resistance of 267.89 and then 271.30 for the bulls to break in order to see a bull break on this weekly pattern. And if we get that bull break, we will be looking back towards all-time highs. If we can get back over the middle Bollinger Band on the weekly, turn the daily moving averages all back into support, that's what the bulls need to prove themselves in this current scenario. So a lot of people are bearish fundamentally for different reasons, whether it's the 10-year yield or the tech sector being overdone, things like that. But the bottom line is we absolutely could see new all-time highs this year. We have to keep that in mind and just watching this tightening weekly pattern for some more clarity. This week, in my opinion, was all about the tech sector. The tech sector single-handedly saved this market, and Apple was the biggest reason for that. Apple is the biggest holding in XLK and some tech sector ETFs, and the tech sector is the biggest holding in the S&P 500. Therefore, by default, that makes Apple one of the most important individual stocks for me. They had a bullish reaction to earnings. They had bullish news with Buffett buying more in Q1 2018, and they're at all-time highs. So again, as I keep saying in these videos, this market is not going to dump if we have high flyer tech names like Apple. Let's look at these weekly charts. So Apple, all-time high on the back of earnings. Amazon, all-time high after earnings, seeing healthy consolidation. Facebook, bulls making their way back towards the all-time high. Still some work to do, but and Microsoft's another one, all-time highs. So as long as we are seeing these major tech names continue to hit all-time highs, we are not going to see market weakness. In order to see significant market weakness, we have to see the tech sector sell off. Here's XLK, the tech sector, and it is just not happening. We are close to a bull break of the weekly equilibrium as the tech sector is more bullish than the S&P 500. Why is that? The answer is because the financial sector has been weak. The financial sector is the reason we had weakness after the FOMC. It is the reason that IWM and QQQ are both outperforming SPY this past week because they do not have the financial weight in their holdings to see that bearish action, and they're more weighted towards the tech sector, which was seeing bullish action. So again, for the market to dump like we've seen in February and March on those multiple pullbacks for SPY, it has to be with the tech sector and the financial sector both going down. If one's going down and one's going up, we can pull back a little bit, we can go up a little bit, but we're not going to see magnified action in either direction if they're playing tug of war. It requires both sectors going in the same direction to see significant moves. So as long as the tech sector, and my gauge of the tech sector again is Amazon, Apple, and Facebook. Those are the 3 names that I'm looking at to gauge the sector overall. Netflix as well. And as long as they are bullish and not seeing significant breaks of weekly support, the market bulls are just fine. So IWM, a lot more bullish than SPY. IWM is on Friday hit the highest price that we have seen since April 24th. For SPY to hit the highest price that we've seen since April 24th, we would have to be up at over 267.89 at about 268. So again, almost 0.8% below where IWM is on its standing. And in terms of the chart to break bullish on IWM, 158.38. Again, all about the tech sector, in my opinion, as to whether or not this market is going to break this weekly pattern bullish. And we should know sometime in this month in May. And let's go back to SPY real quick on the weekly to see how it could play out with this tightening range. I'd say another 4 weeks, we will definitely either see a bull break of 271.30, which will significantly shift odds to favor the bulls back towards all-time highs, or a bear break of our recent low, which would have us right on top of our other must-hold support levels. So as of right now, market bulls ending the week, saving the week with a long lower wick, thanks to the tech sector. QQQ, most heavily weighted in tech sector, never broke the higher low from April 25th. Again, SPY did. SPY broke that support level on Thursday, and QQQ is breaking resistance. We already broke the high of April. Let's see, QQQ seeing the highest price that we've seen since April 29th. So that would require SPY to be even stronger to be on the same page, which we obviously aren't. 167 key resistance, and QQQ breaking 167 will have us looking towards the gap on the weekly at 170.62, and then that all-time high. So again, the bulls shifting their momentum on Thursday and Friday does give them the setup this coming week to, if we see continuation, to push forward and break some key resistances and make some significant changes in the overall odds of how this weekly chart is going to play out. If we do not get that follow through, we'll just have a tightening range and some decreased volatility and volume over the next week or two while we wait for that clear break. VIX, on the other hand, is breaking, and it is extremely weak and dropping down to lower lows. And if this market goes back to all-time highs, we're going to be looking for VIX to see further weakness. VIX, I should say. Let's see if TVIX, if we saw this long lower wick down, and we didn't, so I would call that a little bit of a fluke on VIX. But we're looking down at the low of this pullback of 653 on TVIX, and on VIX, that would put us, again, that skewed day doesn't give us a whole lot of information. So I'm pulling up the shorter term time frame real quick to see what our actual low of that day was, and it's looking like it was down at 1470. So almost closed at the low of the day, 1470. We did break to the lowest price that we have seen since April 17th. If we break 1457, we're looking down at 1331. The weekly chart is breaking down, and the bulls must show up sooner rather than later if we're going to get a bull break on VIX. But again, at this point, shorting VIX continues to seem to be the way to go, because even when we did see market weakness on SPY in reaction to the FOMC and the financial sector weakness, VIX still didn't do much for the bulls. So it continues to be a long-term short play for traders that use it as an ATM. And if we get a bull break on these weekly timeframes for the markets, then we could see some follow-through. So the scenario heading into this coming week is, number one, the tech sector continues to run wild with Apple at all-time highs, surging and leading the way. Now that most tech sector earnings are done, that's a potential that the market continues strength. Another potential is that the tech sector holds up and trades sideways, and we get a financial sector oversold bounce and some recovery. And let's just compare the financial sector to the tech sector. So XLF, you can see we dropped down. We hit the lowest price this past week on XLF that we have seen since November 2017. So we hit 2018 lows this past week. Look at XLF. Where were 2018 lows? We would have had to have dropped below 60, 78, 10% lower than where we currently stand. So again, tons of strength in XLK. And another reason for strength is XLE and the energy sector. Look at the weekly chart on XLE the last month, helping the market significantly. Not as much weight as the tech and the financial sector, but certainly notable. And oil is just on fire with a lack of resistance over $70. As long as oil and energy stays strong, and as long as tech stays strong, market bulls will hold up just fine longer term, and the possibility of all-time highs in 2017 are absolutely possible. This doesn't mean, we're not switching and saying, all right, it's all bulls now. We're just saying, okay, we saw a break of some key daily supports on SPY. The tech sector bulls showed up and saw a complete reversal and very strong bounce from those support breaks, and now we're still right back in that tightening pattern. Essentially, it was just bulls saving from a bear break. So now we're going to see how the next 2 weeks play out, and we'll check in day after day. Have a good rest of your weekend. We'll see you soon.